Hello everybody, this is Nick Fenton here, founder of TickerTank.com, coming to you with part 4 of 7 in our Naked Puts Entry Criteria video series. Today we're going to discuss being comfortable with your cost basis and implied volatility. A few different topics with regard to implied volatility, which is very, very important when looking into a Naked Puts strategy. So first let's just quickly cover cost basis. What is cost basis and why do you need to be comfortable with it? Let's take it back to that BBRY example we used in some of the previous videos just to keep things kind of streamlined. So let's say we've got BBRY here trading at $14.99, right? The May has 43 days left, so we wouldn't really want to enter right now because, as we discussed in part 3, the time preferences, sweet spot for entry is between 50 and 65 days. But just for sake of example, let's say we're entering the May, we're going to sell some May naked puts in BBRY. Currently it's trading at 15 bucks. Let's just say we want to go 2 strikes out of the money and sell the 13s. The 13s are currently, the bid is currently 58 cents, so that's what you can sell it for, 58 cents. So what does that mean? If you just sell the May 13s, what if, say for example, tonight Bloomberg announces a total shakeup in their management and the fact that their latest smartphone is totally flopped and the stock opens tomorrow morning at 10 and you had sold the 13 puts today at 58 cents. Well, that's one of those cases where kind of screwed, and that can happen. That's why I like doing diversity underlyings with pre-diversified elements to them, like SPY and things like that, like we discussed in part 1. But back to cost basis. So you might think to yourself, okay, does that mean that I'm long from the 15 price that BBRY was trading at when I initiated and entered the trade? Does that mean that I'm long from the 13 strike that I sold? Well, it's neither. You're long from if the shares are put to you. You know, if BBRY does not rebound and after 43 days it's still trading, say around 10 or 11 bucks, you're gonna have the shares put to you, and you'll be long from the 13 strike less the premium that you sold. So in this case, it would be 13 minus 58, which is $12.42. So before you even consider selling these naked puts, you have to say to yourself, am I comfortable in a worst case scenario being long 100 shares per contract, however many contracts you sell? So let's just say one contract. Am I comfortable being long 100 shares from a 1242 cost basis in BBRY? Well, in order to determine that confidence level, you can kind of incorporate a little bit of technical analysis, and you can come over here to a BBRY daily chart here. We're just looking at a 1-year chart, and you can say to yourself, okay, 1242 is right around, right in this kind of general vicinity here. And what do I have going for me in the event I have shares put to me? Well, you've got some pretty nice support right here at 12. There's some previous resistance turns support. So you have come resistance in this area, resistance in this area, resistance in this area. Broke through, came back, tested that resistance turn support, bounced nicely, came back, tested that resistance turn support, bounced off. So it seems like there's pretty good resistance right around that 1250 area. So you got that going for you. That might be enough to make you comfortable saying, okay, I am comfortable being long from 1242 cost basis worst case. Now, of course, if that move happens and drops all the way to 10 overnight, then that support level is pretty much done. But what you can do, and this is another topic that we can discuss later, but what you can do is, I've done this before in the past, you can just sell calls against your long position. I have had naked puts put to me in a few cases, not very often, but there have been cases where it's been a rough situation and I've had the shares put to me. What I've done is, once they're put to me, I sell calls against them and continue to reduce my cost basis to a point to where in some cases I've taken a small loss, in some cases I've broken even, in some cases I've actually come out with a profit in the end. But in most cases, I'd say 90% of the time, I do not get shares put to me because of what we discussed in the time preferences video in part 3. I like to enter with 50 to 65 days until expiration. I like to exit no later than 7 to 10 days prior to expiration. But in most cases, I'm exiting as soon as I get an opportunity to get about 20, 25, 30% return on capital, which has happened in a couple days in some instances to me. Sometimes it takes a couple weeks for that to happen. But naked puts is a very high probability of success strategy if you do it the way I do it. So more often than not, you're going to be taking profits on the trade, and you're not going to be getting shares put to you. But it will happen. So just know to be comfortable with the cost basis in the event that worst case scenario does happen before you even enter the spread. If you're not comfortable owning the stock from the strike price that you sell, so let's go back here. If you're not comfortable owning from the strike you sell less the premium obtained, which is your cost basis, then you shouldn't do the naked. You shouldn't initiate the naked put spread or strategy. So that's it for being comfortable with your cost basis. Let's move on to implied volatility. So first I want to show you an example of why I wouldn't be selling SPY puts right now. Even though SPY is extremely liquid, and I'm using SPY again for the sake of keeping things streamlined and standardized. We'll stick with a few tickers just to keep things simple. So SPY, I would love to be able to sell naked puts in SPY because it's so diversified, it's so liquid. It's just a really optimal underlying to sell naked puts in. And I'm comfortable being long from a specific cost basis in most cases for a variety of reasons, which we won't discuss right now because I'm not even going to consider selling SPY. The reason I'm not going to consider selling SPY, if you look here, May 13, we've already discussed this, your standard May options. We've got 43 days left until expiration. We've got shares per contract and dollar value here. So there's going to be 100 shares per contract. But if you go all the way over here to the right, if you go all the way over here to the right, it shows 14.07. Well, what does that mean? If you put your mouse cursor and just let it rest there, it tells you that that's the implied volatility. So the average implied volatility, averaging out all these different strikes, the implied volatility of all these strikes, is 14.07. And that indicates that the option market thinks that there's going to be a move up or down, which is this plus or minus, of roughly 6 points in the next 43 days. So by May expiration, they expect SPY to have moved up or down no more than 6.05 points. Another handy tool is if you scroll down here to today's option statistics, you can see a few things. The first of which is your 52-week IV high. IV stands for implied volatility. That is 25.9%, so roughly 30%. 52-week IV low is 11.3%. The current IV percentile is 18%. 18% indicates that the current implied volatility in SPY is towards the low end of this range. It's towards this 11.3 52-week low. When you're selling naked puts, you want to be selling when premium is high, when implied volatility premium is high, not when it's low. So you wouldn't want to be selling naked puts in SPY because the implied volatility is near its 52-week low range, meaning that there's not a whole lot of volatility premium baked into these options. So it's not that attractive to sell premium. You want to be in a situation where it's very attractive to be a seller of premium, not where, in this case, it's more attractive to be a buyer of premium, say via buying a debit spread. So what would be a good example of a stock, an underlying that could be a good candidate of selling naked puts? Well, we recently sold and we were already covered for a profit, but it's still one that can be good from an example perspective. CLF, Cliffs Natural Resources. So what you're going to see here is a much different picture than what we just saw in the SPY options. So again, we're looking at the May 13th with 43 days left. If you go over here to the far right, 62.94% is the implied volatility. That's a much higher implied volatility than SPY. But it's all relative because some stocks have higher historical volatility levels than others. The typical historical volatility for SPY is 15 to 17%, whereas in this stock it's more like 40%. But in SPY we're right at that typical average historical volatility, whereas in CLF we're above. Well, how would you know that? Again, utilizing this today's option statistics tool is really helpful. You can see the 52-week IV high is 64.4%. Going back here, 62.94, that's pretty darn close to that 52-week high of 64.4, wouldn't you say? And then our 52-week IV low is 37.8%. Current IV percentile is 90%. Remember I said the higher the better. This is almost as high as it gets here. So this is a really opportunistic time to consider selling naked puts in CLF. Unfortunately, the May and the June options aren't in my time preference sweet spot of 55 days or 65 to 50 days until expiration. So I'm not going to be selling any CLF puts, but we did a couple weeks ago. And why did we sell those CLF puts? I'll show you exactly why. First of all, we noted that it was trading towards its current IV percentile high. Let's go over here to charts and let's pull up a CLF chart real quick. What you can see here is we've got the price at the top. This green line here is the 200-day moving average, which we don't really need to pay too much attention to in this case. Then we've got a volume, and then we've got our implied volatility. To see how you can set your chart up to look like this, you can reference back to a YouTube video I've already made where I share how to implement the exact settings that I use. Just go to the youtube.com/TickerTank and scroll through. It was around it was towards the end of March 2013. So just a couple weeks ago from today, but if you're watching this well in the future, look in the mid to late March 2013 where I share how to set up my chart preferences in Thinkorswim. But anyway, so real quick, the study that we have at the bottom, you can just click on Studies, Add Study, go down to Volatility Studies, and add Implied Volatility. Another useful one is this Historical Volatility right above it. But in this case, Implied Volatility is the one we're going to be using. It's already loaded on the screen, so I won't click that. But what you can see here is, let's bring up the Channel tool. And you can see we've kind of got a lower end of the range, right around this 40% implied volatility is kind of the low end of the implied volatility range. And then the top end of the range is right around 63, 65. It's, really 63 is kind of the top end of the range, 63, 65 area. What we saw is a quick spike from 44 all the way up to this 63 level, and we noted that the implied volatility was trading near the high end of the range, which in turn provides an opportunistic time to consider selling naked puts. Why is that? Well, when you're a seller of premium, you want to sell when the implied volatility levels are high so that there's more of a probability of them going down, which in turn means that the premium is decaying, and as a result, the value of whatever you sold is going down, and you can cover at a lower price and keep the spread, keep the profit. So we noticed this, and we said to ourselves, okay, that's a really good lead. What else might be attractive about this? Well, if you go out to a 5-year chart, at the time we did it, it was pulling back to this 20 price point, and you can see on the 5-year chart, it did go through 20 a few times back in the past, but that 20 level was definitely a level where we might see a quick reaction, at least an initial reaction. We saw some nice support there. We saw a little bit of congestion followed by some support right in that area. We saw a support bounce there, and we saw a little bit of support in this area. Granted, that one quick drop was pretty swift and well below 20, but this 20 level, there's definitely some interest way back in the past 5 years ago that could come into play here from a shorter term perspective for a quick bounce in CLF. So we literally entered this spread, or we sold the naked puts. We ended up selling the 17s, if I remember correctly, when this was right here at 20. It had a nice few days of upside, and I kid you not, we sold it right here on this day, or we covered the spread for a decent profit. It was about a 35% return on capital. We covered right here. Then following day, there was a downgrade, and it pushed the stock all the way down to this 18 level, where we still were well above our 17 strike price. So if we would have continued to hold, it would have ended up being a winner, most likely. But you know, it was a nice opportunity where we recognized a potential short-term pop area from a support level way back in the day, coupled that with the extremely high implied volatility, which made it a really attractive looking situation to sell premium. So that kind of gives you an idea of how to look at implied volatility in relation to the naked put strategy. Right now, it's much more difficult to find good naked put candidates than it was, say, towards the tail end of 2011, or the last 6 months of 2011. Why is that? Well, that is because if you pull up a chart of the VIX, you can see we're at a pretty low range. Let's go out to a 3-year daily chart, and what you can see is this was a heyday where I was just having a good old time making all kinds of money at the end of 2011. And so like the last 6 months, you know, even this area provided a lot of opportunities. So when we had VIX levels up in the 30 to 45 range, all kinds of super liquid underlyings had great opportunities to sell puts and met our naked put, or met my naked put selling criteria, including SPY. So I was selling naked puts on SPY left and right. It was great. It was beautiful. A lot of people were getting really scared up here and losing money, but I was making money hand over fist because I understood the opportunity that was in front of me. I had this tool on my belt. I understood the strategy. I had specific criteria that was being met, so I knew that I like the trade, and I went ahead and stuck with my discipline criteria, and it worked. Right now, you can see we're well below here. We're in what is known as a low volatility market environment versus this area where we were in a high volatility market environment. So there's far fewer opportunities to sell naked puts down at these levels. You really have to go hunting to find a good opportunity. You know, recently we've been lucky enough to find CLF, JCP, and BBRY as good naked put strategy, or good naked put candidates, and we did initiate and fill entries on those, and we did cover for profit on all three recently. But those are about the only three out there that had any attractiveness, that had liquid options, and you know, met the rest of our criteria for selling naked puts. Now in part 7, I'm going to show you how to scan to find these specific stocks in the same way that I found JCP, BBRY, and CLF using this scanning tool, and then applying my criteria once I found those few candidates via the scanning method. But that's going to happen in part 7. This concludes part 4 of 7, which we started off talking about being comfortable with your cost basis before you enter the spread, or before you enter the naked put strategy. And we discussed the importance of implied volatility, how to determine if implied volatility is attractive for selling a naked put, and you know, looking at those those options statistics here, today's option statistics, and looking at that IV percentile. You wanting that to be towards the high end. You know, the higher the percentile, the better. So that concludes. Hopefully, you understood everything that I said here. And if I was at all confusing at any point, please feel free to leave comments in the comment section. I will answer myself personally as quickly as possible. Otherwise, I'll see you in part 5. And we are going to discuss return on capital in part 5, which is extremely interesting. And it's one of the hidden gem secrets of selling naked puts. I don't want to sound corny and salesy, but I swear this definitely would qualify as one of those hidden gem secrets that, you know, it took me a couple years to even figure out and find out this existed. And it's very, very, very helpful for this strategy. See you then.